You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back, everyone. Today, we're diving into the world of FinTech, specifically looking at some really interesting shifts happening right now. Think of it as a quick download for founders trying to navigate this space.
Absolutely. There's a lot going on, big valuations, new tech, regulatory hurdles.
Yeah,
It's moving fast.
right. So let's get straight into it. Market movers. First up, Ramp. I mean, 6 years old, and they've hit $1 billion in annualized revenue.
It's pretty wild. And that's off a, $22.5 billion valuation?
Exactly. And it seems like they're outpacing rivals, not just with the corporate card thing, but by adding all these tools for CFOs.
Expense management, travel, procurement, even accounting integration. It's become a suite.
But the really interesting angle is this AI piece. Investors apparently see them almost like an AI company now because of these automated agents.
Yeah, that's the narrative gaining traction. These AI agents aren't just simple automation like matching receipts. They're automating approvals, flagging anomalies, getting smarter.
So what does that actually mean, though, for a fintech to be seen as an AI company? Is it just hype or?
Well, it's partly about efficiency, sure. Automating tedious tasks saves money and time. But it's also about moving towards more proactive insights.
Proactive how?
Like predicting cash flow issues before they happen, or identifying potential fraud patterns much earlier. For a founder, that transforms the finance function from just reporting the past to actually shaping the future strategically. That's the leap.
Gotcha. That makes sense. It's a deeper integration.
Exactly.
And speaking of market signals, another big one, Robinhood. They're joining the S&P 500.
Right, along with AppLovin and Emcor. It's a significant milestone.
Definitely signals that shift towards, tech and digital platforms really driving market performance these days. It kind of cements their position.
No doubt, it's mainstream validation.
Okay, let's switch gears to innovation. There's this surprising challenge popping up with some AI coding platforms, the unit economics problem.
Ah, yes. You see these amazing UI generation tools like Vercel, Lovable. They can spin up websites super fast, incredible growth. But they're burning through cash. The cost to get a customer and keep them running on the platform is often higher than the revenue the customer brings in. That's the unit economics problem in a nutshell.
So fast growth, but it's costing them more than they make per user. That sounds unsustainable.
It is, long term. And the solution they're exploring is pretty radical. It's not just about finding cheaper computing power.
What is it then?
They're looking at becoming fintech companies themselves through embedded finance.
Embedded finance, like integrating financial services directly.
Precisely. Think payments, lending, maybe even insurance, baked right into the coding platform. It turns what was just a software tool into something that also facilitates financial transactions, creating new revenue streams.
Wow, okay. So AI companies becoming fintechs to solve their cost problem. That's a twist.
It's a fundamental shift. It points towards a whole new business model, especially for B2B AI. Integrating finance isn't just an add-on. It might be crucial for survival and profitability.
Which ties into how the actual payment rails are changing, right? Like Stripe's new blockchain, Tempo.
Yeah, that's another huge development. Stripe spinning out Tempo, and look who they're partnering with. Paradigm, Visa, Shopify, Deutsche Bank, Nubank, even OpenAI.
Heavy hitters.
Absolutely. And the key thing here is what Tempo is for. It's explicitly built for real-world stuff. Payments, stablecoins.
Stablecoins being the crypto pegged to, like, the dollar, right? For less volatility.
Exactly. Plus payroll, remittances, cross-border payments. It's deliberately steering clear of the purely speculative side of crypto.
So this isn't just another crypto project. It's Stripe using blockchain for actual everyday financial infrastructure.
That seems to be the goal. For founders, this could be massive. Imagine using Tempo, for instance, super low-cost global payouts to your remote team or contractors, or enabling microtransactions for digital content that just weren't feasible before.
It makes blockchain payments feel, I don't know, more practical, less niche.
Definitely aims to bring it into the mainstream for businesses, especially larger ones. It could really lower friction for digital commerce globally.
Okay, but it's not all smooth sailing. There are always challenges, like this spat between Stripe and JP Morgan.
Ah, the open banking battle. Yeah, Stripe is pushing back hard against JP Morgan wanting to charge fees for accessing customer data via APIs.
APIs being the way different software talks to each other, letting fintech apps connect to your bank account with permission.
Correct. Stripe's basically asking the regulator, the CFPB, to step in and say, hold on, you can't just start charging fees for this data access before we have clear rules.
Why is that so critical? It sounds a bit technical.
It's huge. Open banking is all about letting you securely share your financial data with third-party apps you trust, fostering competition and innovation. If big banks can just put up toll booths, essentially before the rules of the road are clear.
It could freeze out smaller fintechs, the ones trying to build new services.
Exactly. It limits consumer choice, could drive up costs, and basically hinders the whole promise of open banking in the U.S. before it even gets properly started. It's a fight over the future shape of financial innovation.
High stakes. And speaking of data, but more on the security side, this TransUnion breach.
Right, affecting about 4.4 million people through a third-party app. TransUnion says credit data wasn't compromised, but personal details were.
Still worrying. What's the takeaway for a founder there? Beyond the obvious, be careful.
It's a massive reminder about third-party risk. You absolutely have to vet who you integrate with, especially any service that touches customer data via API. Robust data governance isn't optional.
And vendor management needs to be ironclad from day one.
Absolutely, because customer trust is so hard to win and so easy to lose. One breach via a partner can seriously damage your reputation, maybe even kill your business.
Okay, so wrapping this up, we've seen incredible growth like Ramp, fueled by AI. We've seen AI companies looking to fintech for sustainable models, new infrastructure like Tempo emerging, and these ongoing battles over data access and security.
It's a really dynamic mix of opportunity and challenge.
Definitely. So maybe the final thought for you listening is this. As you're building, how do you strike that balance between leveraging all this amazing new tech and financial integration while also ensuring rock-solid security and fair data practices? Where do you see the biggest opportunity in all these shifts?
Yeah, navigating that intersection, that's the key challenge and opportunity for founders right now.
Spoken Tech for your ears.